Okay. Hello, friends. Today we are going to study about our final accounts, the formats of our final account. That means our income statement and the statement of financial position. Also, we are going to study about what constitutes the income statement, the main components of income statement, who prepares the income statement and statement of financial position, and the adjustments that is related to the income statement. Now, this would be a revision of your entire concepts that you have learned so far. So let's start with it. Okay. Can you tell me what is the difference being a sole trader and being in a partnership? Think about it and tell me, because this is our focus question, and we are first going to start with the statements of a sole trader. Think about it, giving you all some time to think and let me know what is the difference between a sole trader and a partnership. Sole trader means one person doing a business. Partnership would be more than one person doing a business. More than one, that is, it starts with two. What could be the other advantages and what could be the other difference between a sole trader and partnership? Whatever profits is earned, a sole trader is going to take the benefit of all the profit. However, when you are in a partnership firm, whatever profit is earned is shared among the partners. What else? When you are a sole trader, you have less capital because all the capital will be shared by the owner, will be brought in by the owner or loaned from friends and family. But when you are in a partnership business, the capital is shared by the partners. Okay, so this is a difference between a sole trader and a partnership. Let us look at the advantages and disadvantages of sole trader. Okay, let's move ahead and look at the advantages and disadvantages. Before that, do you all know what are the different forms of business whose income statement we would be studying? So we are going to study about the financial statements of a sole trader, partnership company, and limited companies. Before studying that, let's look at a little bit of theory. What is the advantages and disadvantages of being a sole trader? So the advantage of being a sole trader is that a sole trader has complete control over the business. He is going to completely control the business. There is a direct relationship between efforts and rewards. That means whatever efforts the sole trader is going to put, he is the one who is going to get rewards. If he puts no efforts, he will get no reward. And another advantage of a sole trader is that there are very less legal formalities required if you want to start a sole trading concern. You bring in capital, register, start the business. The formalities, the legal formalities are very less. What is another advantage of being in a sole trading concern is that you are the owner, you are the manager, so the decision making is very quick. These are the advantages of being in a sole trading business. However, the disadvantage is that there is unlimited liability when you're doing a sole trading business. Supposingly, if you go to pay off the debts means the loans or the credits that you have taken. If you go to pay off the debts of the company and if the assets are not sufficient, then the personal property of the sole trader could be sold to pay off the debts. That means the liability of the sole trader is unlimited. The sole trader, because he is the one who's doing the efforts, he's the one who's going to get the rewards. So there will be long hours of work. Another thing, because he's the only person doing the business, it becomes very difficult to raise extra finance. Kids, you need to learn the advantages and disadvantages of operating as a sole trader. Okay. Now, because it is difficult to raise extra finance, can you tell me what could be done if you want to expand the business or if you want to raise extra capital? Any idea? If you want to expand the business or you want to raise extra capital, what we can do is we can convert the business into partnership or limited company. Let us recall our financial statements that is prepared by a sole trader. Let us recall the financial statements prepared by a sole trader. Do you all know what is financial statements? When we talk about financial statements, there are two financial statements which a sole trader prepares. One is the income statement and one is the statement of financial position. There are two financial statements prepared by a sole trader. One is the income statement and one is the statement of financial position. Do you all know what does an income statement tell us? An income statement will tell us how much income we have earned or how much loss we have suffered. Okay, that means it tells us about the performance of the business. That means it tells us about the performance of the business. Our income statement is divided into two parts. One is the trading section of the income statement and one is the extension of the trading section, which goes ahead of the trading. Trading section of the income statement shows us the gross profit. And the extension that starts with the gross profit, it records the other expenses, losses, incomes, and gains. And it shows us the net profit. What is the difference between gross profit and net profit? Gross profit is the profit that is earned exclusively due to trading. That means the profit that you earn because of buying and selling. The profit that you earned because of buying and selling is the gross profit. After that, you would deduct the other expenses that is required to administer the business, that is required in the warehouse, in the showroom. You would deduct the financial expenses. You would add the other income which is not the trading income. Then you would arrive at the net profit. So the trading section and the extension of the trading section, both together will show you the performance of the business. You all remember anything about the statement of financial position? What is it? It is also called as the balance sheet. Statement of financial position is also called as the balance sheet. What does it show us? It shows us the position of assets and liabilities. And the position of assets and liabilities is shown on a particular date. Please remember, the statement of financial position is a positional statement which just shows us what is the assets and what are the liabilities on one date. However, the income statement, both the trading section and the extension, will show us the performance of the business. Let's move ahead. Do you all remember the format of an income statement? Anybody? If you all remember the format of an income statement, you all can pause, write the format, and then come back and revisit if you all remember. Okay, so when we are talking about the income statement of a sole trader, first thing that you should remember that it will always be income statement for the year ended. That means it is prepared for a period. The period could be 1 year or the period could be 6 months. So the statement is prepared for an entire duration. So it is income statement for the year ended. Let's move on. It will have details, dollar and dollar. You could have an extra additional column, a third column for doing your calculations. Okay. So let us see. The income statement always is for a particular year, for the year ended. I'm making 3 columns. This would be my first column, this would be my second, and this would be the outermost column, or I could say the third column. Income statement is always for the year ended. It starts with sales. Sales are the goods that you are selling. From that, if there is any sales return, you would deduct it and you would write the sales minus sales return, which is the revenue that you will consider while calculating your gross profit. Sales minus sales return, the revenue, the main answer, the revenue should come in the third column. So sales minus sales return gives you revenue. Let's recall again. You would have your sales. From the sales, you would subtract your sales return. You will get your revenue. Remember, whenever we refer to the word revenue, it would be sales less sales return. Okay? Then from the sales, you will subtract your cost of sales. That means from the revenue, you will subtract the cost of those goods that you have sold. You would subtract the cost of those goods that you have sold. When I'm saying that I will subtract the cost of those goods that I have sold, that means the goods that I did not sell. The goods that I did not sell. The cost of those goods has to be removed from the revenue. From the revenue, that is sales less sales return, I will subtract the cost of those goods that I have sold. That means the goods that I did not sell, those goods, the cost of those goods will have to be removed from the cost of sales. So do you know the goods that you do not sell is called what? It is called your closing inventory. So the closing inventory has to be removed when you calculate the cost of sales. Now let us see what our cost of sales is made up of. Whatever opening inventory you have, that means the inventory that you started the year with, that is also going to get sold in the current year. So you start with the opening inventory. In that, whatever goods that you've purchased, you're going to add it. See, I'm writing this in the inner column because the cost of purchases, the purchases for the year has a lot of adjustments to be done. From the purchases, you're going to subtract the purchase return. Purchase minus purchase return will give you your net purchases. I repeat, purchases minus purchase return will give you your net purchases. In that, you will add the carriage inward. Remember, always remember, most important point, carriage inward is taken as a part of cost of sales, or to be more precise, it is taken as a part of purchases. Because all the expenses that you incur to get the product in your warehouse is added to the cost of purchases. So carriage inward is a part of your purchases. Again, we see when we're doing our cost of sales, opening inventory, that would be in the second column. add the purchases, less the purchase return. What you will get is the net purchases. In that, you will add your carriage inward because it forms a part of the cost of sales or the part of the purchases that you've done. Okay. From that, you would subtract the goods that you've taken for own use. Because the goods that you take for own use are those goods that you purchased. And now you're taking it for your own use. So goods for own use is always removed from the goods you purchased. Because you're not going to sell these goods, the goods you purchased. So could you give me the entry for goods for own use? It is also referred to as drawings. Drawings is removed from purchases. So purchases is credited and drawings would be debited. So to be more clear, the goods that you take away from the business from your own use, for your own use, is always removed from purchases. We repeat, the goods that you take away for your own use from the business is always removed from purchases, because now these goods are no longer going to be sold. So they cannot form a part of your cost of sales. Less the goods for own use, you will get the figure for your purchases. So remember, opening inventory, add the purchases. Add both of them, arrive at a figure. From that, you would deduct the goods that you could not sell. The goods that are not the cost of goods sold. The goods that is left unsold, which is called the closing inventory. From that, when you deduct your closing inventory, you would arrive at cost of sales. So your revenue less cost of sales would give you your gross profit. This is the trading section. This is the trading section of your income statement. This is the trading section of income statement. Remember, the income statement does not stop at the gross profit. You still have an extension to it. The trading section does not stop at the gross profit. You still have an extension to it. Let's recall again the income statement trading section for the business. Income statement is always prepared for the year. So it is income statement for the year ended. We make 3 columns. It starts with revenue. However, revenue you get when you subtract from your sales. What will you subtract? Your sales return. Very well. So from the sales, when you subtract your sales return, what you get is revenue. From the revenue, I will subtract the cost of sales. So in the third column, the figure that I want is of the cost of sales. Please remember, in the third column, the figure that I'm looking at is the figure of the cost of sales. Less the cost of sales. Opening inventory, second column. Add the purchases. Purchases have a lot of adjustments to be done. So all the adjustments you will do in the first column before arriving at the proper figure of purchases to be written in the second column. From the purchases, subtract the purchase return. What you will get? Net purchases. Add the carriage inward, which is taken as a part of cost of sales. Minus the goods for own use, because you've taken the goods that you purchased to your home. So the expense of purchase would reduce. You get the purchases. Opening inventory at purchases arrive at a figure. Less the closing inventory, the goods that you could not sell, though purchased. Closing inventory is the goods that you purchased to sell, but you could not sell. Because you could not sell, it is not a part of cost of sales. It is not a part of cost of goods sold. So you would remove it and come at the part of cost of goods sold. From your revenue, when I would subtract the cost of sales, I will arrive at the gross profit. Please go back, revisit it again and again. Let's do it once more before going ahead. Sales, less sales return. Revenue less cost of sales. Opening inventory at purchases minus closing inventory. Purchases has a lot of adjustment. Purchases less purchase return would give you net purchases, add carriage inward, would give you an amount. From that, you would subtract two things. Goods for own use, you arrive at a figure of opening inventory at purchases. This would be the goods lying in godown now. Whatever you sell will give you gross profit, but whatever you don't sell, that means a closing inventory lying unsold, you remove from it, you get your cost of sales. From the revenue, when you subtract your cost of sales, from the revenue, when you subtract your cost of sales, you arrive at a figure which is called as your gross profit. Am I very clear? Okay. Now we go at the extension. Now we will go at the extension of the gross profit. In the gross profit, when you add the other expenses, remember you will have in the third column. In the third column, you will have your revenue. In the third column, you will have your cost of sales. From the revenue, when you subtract your cost of sales, you will get gross profit. This will also be in the third column. So the third column would always have the main answers. In the gross profit, okay, when you add the other income, that is other extra income, which is not revenue, like commission received, discount received, such interest received, all the received parts that you add, you would add it in the second column. You would arrive at the other income. Gross profit, add other income. You arrive at an answer. From that, you're going to subtract all the expenses, the other expenses that you've incurred. Other expenses would be your office and administration expenses. It could be your financial expenses. That means the interest on the loan that you've taken. Bank charges. Selling and distribution expenses like the bad debts, advertisement. All these expenses, when you subtract, you would get a total of all the expenses that you've done. Gross profit, add other income, arrive at a figure. Get the total of all the expenses that you've incurred. Minus all those expenses, you will arrive at the net profit or the profit for the year. You would arrive at the net profit or the profit for the year. Anything you can write. Okay. Please note the profit for the year figure is very important. Why? Because we will use this figure again to prepare our next document, that is statement of financial position. You should already be aware by now that profit increases capital. Losses decreases capital. You should be aware by now that profit increases capital, losses decreases capital. So whatever the figure of profit that you get, profit you will add to the capital. And if you have a loss, you will deduct it from the capital. And the capital is shown in the statement of financial position. So the profit earned or the losses incurred for the year is a very important figure. Why is this figure very important? Because I'm going to use it again. Why will I use it again? To prepare the next document, and the next document is statement of financial position. It is advised that you pause the video, prepare the statement for yourself, and move ahead so that you are clear with the concept. However, there are few important things that you should note while preparing the income statement. First important thing is that the heading is very important. What is the heading? Do you know? It is income statement for the year ended. For the year ended. That is the income statement for the year ended. XYZ months or 6 months ended. It is also very important to note over here that the statement covers a period of time, either 1 year or 6 months. So it is necessary to state the period covered. Another thing, carriage inward is always taken as a part of cost of sales. Please remember, carriage inward is not an expense. So do not show it as less expenses. It should always be adjusted in the purchases. It should always be adjusted in the purchases. Add other operating income received to the gross profit. Okay? And you would deduct the other expenses from the gross profit. Also, another important thing to note over here is that the profit for the year figure is very important because I will use it again when I prepare the next document. And the next document is statement of financial position. So here we are talking about our trading business. Here we are talking about our trading business. Our trading business has revenue, that is sales minus sales return minus cost of sales gives you gross profit, add other income, less other expenses, you come at the net profit or profit for the year or losses. This happens when you're doing a trading business. Trading business, that means you are doing a business of buying and selling. What will happen if you do a service business? A service business does not have goods to sell. So what will be the revenue? So you, in the service business, one which does not buy goods and sells goods, that is an accountant, there will not be any cost of sales. There will be no cost of sales because you don't buy and sell. So in a service business, you directly start with the income, which would be the fees received. You would subtract the expenses and arrive at the profit for the year. Remember, the service business will have no gross profit. They will directly start with income, less expenses. Gross profit is only and only for a trading business. Service business has no gross profit. They directly start with income, less expenses, arrive at the profit for the year. Okay, so can you all tell me, from where do we prepare the financial statements? Think. What are financial statements? Two financial statements. We have the income statement and we have the statement of financial position. That means a post statement which shows us our assets and liabilities. So from where do we prepare financial statements? We have a list of balances that is given to us. We have a list of balances that is given to us. From that, we would decide what would go to the income statement, and what would go to the statement of financial position. This list of balances has a special name. It is called a trial balance. The list of balances has a special name. It is called the trial balance. So what is a trial balance? Think about it. Pause. Write an answer to it. I would definitely show you the answer, but pause and write. So we prepare our financial statements from the trial balance, and a trial balance is the list of all the balances that you extract from your ledger. How do you extract from the ledger? You have a ledger. You will balance the ledger, carry down the balances, any outstanding balances or any prepaids on each account. Okay? And you will write all the balances in a statement, which is called a trial balance. Okay? So let's see what is a trial balance in detail. It is a list of all the balances that I extract from the ledger. By balancing all the ledger accounts, carrying down outstanding balances on each account, even the prepaids are carried down. We will list all the debit balances under a column which is called debit. We will list all the credit balances under a column which is called credit. So we have a debit dollar column and we have a credit dollar column, and this would be the details which would have the names of all the accounts. The two columns, the debit and the credit column, this is the debit column, this is the credit column. The two columns should have the same total. They should have the same total. Okay? And if it has the same total, that means I say that the trial balance is tallied. I would say that the arithmetical accuracy of the trial balance is perfect. This statement that we prepare, this list that we prepare, is called the trial balance. So the debit column will be total. The credit column will be total. The two columns would have the same balances, and it will be called as a trial balance. Let's look at a statement and try and prepare the trial balance. I would prepare my trial balance. I would expect the kids to prepare their trial balance. I would start in 2 minutes. I'm not pausing the video. Let it go on. Let's go on the same pace. So we have Danby, who runs a business on rented premises. These are the balances that were extracted. You need to prepare a trial balance. So you should be very clear about what has a debit balance, what has a credit balance. To tell you, your expenses, losses, assets would have debit balances. And your income, gains, liabilities would have a credit balances. If you do not know about what are expenses, losses, assets, income, gains, liabilities, you could refer to my videos of capital and revenue expenses, which will give you a detailed classification of assets and liabilities. Okay, let's go. Inventory. If you know very well, the inventory in the trial balance is always the opening inventory. Inventory has a debit balance. Inventory has a debit balance. So 4,000 is for the inventory. Sales, they have a credit balance. Purchases are your expenses. 62,000 debit balance. Trade receivables, your debtors, are your assets. They have a debit balance. Trade payables, these are your liabilities. These are the people from whom you've purchased goods on credit. Money is yet to be paid. Credit. Electricity paid, this is an expense. It would have a debit balance. General expenses, again it is your expense, it would have a debit balance. Cash at bank, this is your asset, it would have a debit balance. Drawings always has a debit balance. These are the goods you've taken for your own use. Rent and insurance paid, this would again have a debit balance. It is an expense. Equipment are your assets. It has a debit balance. Capital, if you see, is question mark. You should always know that capital has a debit credit balance always, and drawings always have a debit balance. So I have to find this. As discussed earlier, the total of the debit and the total of the credit always is the same in a trial balance if there are no errors. Let's do the total of the debit. Let's do the total of the debit. We need to find capital as the balancing figure. So I say 4,000 plus 62,000. I'm doing the total of the debit. Plus 10,000 plus 3,000 plus 7,000 plus 5,000 plus 8,000 plus 6,000 plus 29,000 is giving me a total of 1,34,000. This is the total of the debit, and the total of the debit and total of the credit should always be equal if there are no errors. Okay? This is the total of the debit and this will be the total of the credit. Because it is a trial balance, the total should agree. So I need to find this figure. So from 1,34,000, I will subtract the 80,000 first. Then I would subtract the 9,000. I would come at the figure of capital, which is 45,000. Okay. So sometimes a trial balance is also given to find a missing figure. Please remember it should always have a heading. So I will write trial balance. Now trial balance is also for 1 day. So it would be as on 30th April 2003. Okay. Let's go ahead. Let's do the next sum. Hilota. Is there anything that you have to find out? There is no question mark. That means if everything is proper, your trial balance will agree. You should always know that the trial balance should start with a date. Classify the debits and credits. Assets, expenses, losses, gains, losses, drawings are always debit. Another thing to note is that the inventory in the trial balance. Inventory in the trial balance is always the opening inventory. Incomes, gains, profits, capital, liabilities, always has a credit balance. You all can do this by yourself. Try and evaluate. Non-current assets, debit, inventory, debit, bank balance. They have told you it is a debit. In case nothing is mentioned for the bank balance, it will always be debit. Only if credit is mentioned, it would be a bank overdraft. Sales, credit, purchases, debit, carriage outward expenses, debit, rent expenses, debit, wages expenses, debit, general expenses is expenses, debit, trade receivable is your asset, debit, trade payable is your liability, credit, capital always, credit, drawings, debit. Let's put the figures. You all will mention the headings also. I am writing it in short form, but you all are supposed to use the full forms. Inventory, debit, bank balance, debit, sales is credit, purchases is debit, carriage outward is debit, rent 4,000 debit, wages 7,200 debit, general expenses 2,600 debit, trade receivables 2,100 debit, trade payables 3,000 credit, capital 20,000 credit, drawings 7,500 debit. The total of debit and total of credit should always match. Please write the names like this. Now I do the total of the debit. 12,700 plus 3,200 plus 4,515 plus 34,200 plus 950 plus 4,000 plus 7,200 plus 2,600 plus 2,100 plus 7,500. It is giving me 79,000. The total of credit should also be the same. 56,000. 56,000 plus 3,000 plus 20,000. 79,000. If the total of the debit and the total of the credit is the same, if the total of the debit and the total of the credit is the same, that means my trial balance is correct. Trial balance is correct. I could say it is arithmetically accurate. However, it is not guaranteed that there are no errors. Some certainty, with some certainty, I can say that there are no errors. However, you cannot be 100% sure that your trial balance is error-free. Let's do one more example. And this example, I would want you all to do. It is an IGCSE past paper question. If you see over here, I have to find the capital. I have to find this. So the capital has to be found out. And you remember the total of the debit will always be equal to the total of your credit. I'm giving you all some time. You all can do it yourself. Please keep on checking. I'm also solving it. However, I'm not saying it. Provisions for depreciation. That means that an amount you've set aside from your profits for depreciation of fixtures and fittings, amount set aside from profits. What is provision for depreciation? We would discuss it later in our chapter depreciation. But remember, any provisions always is credit. Sales, income, credit. So sales return would be debit. Purchase, expense, debit. So purchase return would be credit. Drawings, always debit. Bank, if nothing is mentioned, it is debit, but they've already told you this is debit. Inventory, debit. Rent paid, debit. Wages, debit. Discount allowed, expense, debit. Other operating expenses, debit. A credit customer. Customer is your trade receivable. Trade receivable, that means an amount that you still have to receive. Debit. Again, credit customer, amount yet to be received from someone. Debit, it is an asset. A credit supplier. A supplier is a person to whom you have to pay an amount. Credit. Capital is the balancing figure that I have to find out. How will I find out? The total of debit should match with the total of credit. I'm writing only the amount. The details you all have to fill. Kids, can you all tell me the inventory in the trial balance is which inventory? It is always the opening inventory. Always the opening inventory. Now see, I have written the debit items in the debit column, the credit items in the credit column. The total of the debit should be equal to total of the credit, but I need to find something in the credit as a balancing figure. So I'm doing the total of the debit. The total of my debit is 1,14,113. 1,14,113. The total of the debit and the total of the credit will always be the same. I wrote the same totals because I need to find this. So from 1,14,130, I would subtract first the 7,500. Then I would subtract the 72,000. Then I would subtract the 2260. Then I would subtract the 4210 to arrive at the capital, which is 28,160. Very well. You can proceed with the next sum. Kids, you all can take a snapshot. Again, you need to find capital as the balancing figure. You will do the total of the debit, and the total of the debit should always correspond to the total of the credit. This amount you would write exactly over here. Bank overdraft is credit, please note. Giving all time. You have to write trial balance as on 31st of January 2013. You can do this sum yourself. I will just discuss the debits and credits with you. Drawings debit, vehicle debit, asset, rent expense debit. Inventory is always the opening inventory. It is an asset debit. Equipment asset debit. Trade payable, amount yet to be paid, creditors, credit. Trade receivable, amount yet to be received, asset, debit. Sales, credit. Purchases, expenses, debit. Carriage inward expenses is a part of cost of sales, debit. Discount received income, credit. Wages, expenses, debit. General expense, expenses, debit. Capital will be the balancing figure. Always the total of debit should match with the total of your credit. Let's move ahead. Here you have to prepare a corrected trial balance. When they say you have to prepare a corrected trial balance, it means this is the wrong one. It contains errors. Let's see. Motor vehicles would be debit. Revenue would be credit. They put it in a wrong place. You have to shift the place when you prepare a corrected trial balance down. Okay, I've given you place. In case you want this worksheet, please subscribe, like, send an email to me, send a comment to me. Your email ID would send it to you on your email. Purchase is debit. Inventory on the first day, debit. See, they've done it wrong over here. You need to correct these errors. Bank overdraft is amount overdrawn from the bank yet to be paid, credit. Cash in hand is your asset, debit. Drawings is always debit. This is the error that they've done. I'm circling the errors that they've done. Discount allowed is an expense. Not an expense, basically it is a loss for you, debit. Error. Operating expense, debit. Wages and salaries, debit expense. Capital, credit. Difference. There is a difference. That means the total did not agree. So there's a difference in the trial balance. Hopefully, if you all do the corrected trial balance, your totals would agree. In case the total does not agree and there are still some errors, then the difference would go in the suspense account. I would want you to do this sum. I would want you to do this sum. Hopefully, the totals should agree. Last thing that I would discuss before ending this lecture. Come on. State the column of the trial balance. That means they want you to tell the debit or the credit, which column of the trial balance, in which each of the following accounts would appear. And they want reasons for your answer. Loans, amount yet to be paid. It would appear in the credit column because a loan is a liability, an amount yet to be paid. A loan is a liability, an amount yet to be paid. Motor expenses. What about motor expenses? Amount yet to be paid. Motor expenses is an expense for the business. Expenses are always debit. Motor vehicle, it is an asset, things that you own. It has debit. Bank overdraft is in amount overdrawn. Amount overdrawn yet to be paid. What is it? Credit. Carriage outward expense would go in the debit column. And commission received, it is an income, would go in the credit column. Okay? Now, just a minute. If we extract a trial balance, that means they're trying to tell you that if you draw a trial balance, okay, and the two sides total to the same figure, that means the total of your debit column and the total of your credit column come up to the same figure. That means I can say with some certainty, I'm repeating, I can say only with some certainty, not 100% accurate, that every debit has a corresponding credit. I can say with some accuracy that every debit has a corresponding credit. I can say with some accuracy that my trial balance is error-free. However, if the totals do not agree, then we can say with some certainty that there are some errors in the double entry system. If the totals do not agree, then we can say with some accuracy that there are some errors in the double entry system. Okay, kids? Let us recall what is a trial balance. Trial balance is the list of balances of the accounts. It is always prepared at a specific date. My trial balance would ensure that every debit entry has a corresponding credit entry. Every debit would have a credit for every transaction. If every debit will not have a corresponding credit, then the total of my debit column and the total of my credit column would not agree. If every debit will have a corresponding credit, then the totals of the trial balance will always match. If every debit will have a corresponding credit entry, then the total of the trial balance will always match, because it would ensure the mathematical accuracy of the accounting records. This trial balance, we use this trial balance to prepare our financial statements. We use the trial balance to prepare our financial statements because it helps a business to measure the progress. What is financial statements? Our income statement and our statement of financial position. However, when we are making a trial balance, or before we make a trial balance, while recording the transactions, accountant can always make errors. What are the errors that we can make? You can remember these errors by using the 2 C's and 2 O's. You can remember these errors by using the 2 C and 2 O. 2 C is error of commission, compensating errors. Error of commission and compensating errors. 2 O would be error of omission and error of original entry. 2 C, commission and compensation. 2 O, errors of omission and error of original entry. Let's see error of commission. Error of commission and compensating, 2 C's. Commission, account name is wrong. Okay, but the amount is correct. That means instead of writing the amount in the account of Malin, you record it in the account of Malini. Commission, the amount is, account is wrong. The name of the account is wrong. So when there is a mistake in the name of either your receivable or payable, and you record the correct amount but in the wrong account, okay, it is an error of commission. Instead of Malin, you record the transaction in the account of Malini. Instead of Salma, you record the transaction in the books of Salman. Okay, so it is an error that can happen. Site error. A name of the account is wrong. So commission is when there is an error in the name of the account. Name of the account is wrong, but the amount is correct. Compensating errors. Okay, compensating errors is normally when a trial balance is either overcast or undercast. So whenever there is a word overcast and undercast, okay, it is a compensating errors. The errors which cancel out against each other are compensating errors. 2 C's. Now let's talk about 2 O's. Error of original entry. 2 O. One is error of original entry and one is error of omission. Okay. Error of omission is when you forget to record. You forget completely to record a transaction. If you forget to record both the debits and credit, so it would be error of complete omission. You completely forget to record a transaction. However, if you forget to record only a part of the transaction, that means you record the debit, but you forget to record the credit. You record the debit, but you forget to record the credit. You forget the debit, forgot to record the credit. So this would be error of partial omission. So 2 C's, one is commission, compensation. Commission, you record in the wrong name of account. Compensating is overcast, undercast. Next would be O, 2 O's. Error of omission and error of original entry. When I talk about error of omission, you forget to record the transaction. If you completely forget to record both the debit and the credit, it is complete omission. If you forget to record only a part of the transaction, it would be error of partial omission. Error of original entry, everything is correct, amount is wrong. Amount is wrong. That is, instead of 1,200, you record 120 or you record 12,000. So when you record a transaction with incorrect amount, it is error of original entry. When you record a transaction with incorrect amount, it is error of original entries. So we did 2 C's and 2 O's. Let's recall. 2 C's and 2 O's. Commission. Error of commission. Incorrect name. Error of compensation. Error of compensation. What will be there in error of compensation? Undercast, overcast. 2 O's. Error of original entry. Incorrect amount. Everything right. The amount is incorrect. Error of omission. Error of omission has 2 parts. One is complete omission and one is partial omission. Complete omission, you forget to record both the debit and credit. Partial omission, you just forget to record part. Either you forget to record a debit or you forget to record the credit. Let's see if we understood. Name the error made. Name the error that you have made. Cash received from Malini, credited to Malika. Wrong name. Error of commission. Okay, wrong name, error of commission. Payment of wages not entered in the books. Forgot to record. Error of omission. Goods of 100 purchased on credit recorded as 1,000. 100 recorded as 1,000. Wrong amount. What error? Error of original entry. Name the error made. Purchase account under added, undercasted. Sales return over added, overcasted. See, an expense is undercasted and an income is overcasted. Both the errors compensate each other, leaving you with no discrepancies. Undercast, overcast, compensating errors. What is it? Compensating error. Let's move ahead. Sales to R Singh, debited to H Singh. Wrong name. Error of commission. Okay. Goods returned to K Betson, debited to K Wilton. Wrong name. What is the error? Error of commission. Wrong amount. Error of original entry. Invoice 1000 for goods sold on credit to Jacob. Recorded in the account as 100. Wrong amount. Error of original entry. Cash paid $50 for general expenses. Not been recorded. You forgot to record. Error of omission. Error of addition. Overcast. Wages being overcast by same amount. Overcast, undercast. Error of compensation. Invoice for goods purchased on credit was recorded. Amount was entered as 1000 instead of 100. Wrong amount. Tell me what error? Error of original entry. Wrong name. Commission. Wrong amount. Error of original entry. Okay. So I think you are clear with the 2 C's and 2 O's. 2C, commission, compensation. 2 O's, original entry. And 2 O's, original entry and omission. Omission is partial or complete. So you know about the 2 C's and 2 O's of preparing of the errors that we've discussed. We've discussed only 4 errors. What are the 4 errors? Commission, compensation, omission, original entries. Let's quickly look at the rules of the debit items in a trial balance and the credit items in the trial balance. The debit item in the trial balance could be recalled with spades. Credit item in the trial balance could be recalled with clips. Spade, debit item, sales return, purchases, assets, okay, expenses. What could be the D? Drawings. This is the debit items in the trial balance. Credits which would go in the trial balance would be capital, liabilities, incomes, purchase return, and sales. These are the credit items that would go in your trial balance. This would be a completed trial balance. It would be on a particular date. The debit column, the total of the debit column and the total of the credit column should agree. If they do not agree, that means it has errors. Tell me, by looking at this, do you think this trial balance has errors? Yes, certainly, because the total is not agreeing. It certainly has errors because the totals do not agree. So your work is to spot the errors, prepare a corrected trial balance. Prepare a corrected trial balance. There is a further worksheet which I have not putting it in the video. Anybody who needs it for solving to perfect the concept of trial balance can put an email to me. Like, comment, subscribe and share. And also please tell me how did you find the video. Thank you so much.